Somewhere around the 1950s, someone made a decision that changed how an entire civilization lived. Not a law, not a war, a product. They packaged your future income, gave it a monthly payment, and sold it back to you as a lifestyle. You were never meant to save up for the life you wanted. You were meant to buy it immediately and spend the next 30 years paying for it. This is the story of how that happened, and why it still controls almost every financial decision you make today. Think about the last big thing you bought. A car, a sofa, a phone on a plan. Chances are, you didn't have the full amount sitting in your account. You didn't wait. You signed something, and the thing was yours that same day. That moment felt normal. It felt like just how life works. But that feeling, that ease, that sense that you can have it now, was engineered. Someone built that feeling deliberately. It didn't grow naturally out of human behavior. It was designed, tested, and sold to you the same way any product is sold. And the people who built it made more money than almost any industry in history. Once you understand how the machine was constructed, you will never look at a monthly payment the same way again. Not once. Before credit existed in the way we know it today, people had a completely different relationship with money. A fundamentally different one. If you wanted something, you saved for it. That was the entire process. You worked, you set money aside, and when you had enough, you bought the thing. This wasn't considered difficult or admirable. It was simply how life worked. Everyone understood it. There was no other way to think about it. Debt, on the other hand, was considered genuinely dangerous. Borrowing money carried real social shame. If a neighbor discovered you had taken out a loan for furniture, that was embarrassing. It signaled that you were living beyond your means, that something had gone wrong. Respectable people didn't borrow money for things they wanted. They waited. Most families kept their spending close to what they actually earned. They bought homes slowly. They paid with short loans from local banks where the manager knew their name. They bought clothes when the old ones wore out. They fixed broken things instead of replacing them. Children grew up watching their parents save carefully, wait patiently, and treat every purchase as something that had to be earned before it could be owned. This wasn't a perfect world. Many people had very little, and even careful saving didn't always get them far. Poverty was real. Hardship was common. But the relationship between wanting something and having it was honest. There was a gap between desire and ownership. You felt that gap every day. And that gap, uncomfortable as it was, protected people from a trap that hadn't been invented yet. Then came the 1920s, and everything began to change. Factories across America were producing goods faster than people could buy them. Cars, washing machines, refrigerators, radios, all rolling off assembly lines in enormous quantities. The problem wasn't making things. The problem was that most ordinary people couldn't afford to pay the full price for those things up front. Manufacturers had a choice: slow down production or find a way to put products in people's hands before they had the money to pay for them. The answer they chose would reshape the entire world. They introduced the installment plan. Take the product home today. Pay for it in small pieces over time. It seemed generous. It felt modern. It was positioned as a gift to the working family. But it was a business decision, not a charitable one. The installment plan meant manufacturers could sell more, faster. It meant finance companies could earn interest on money that hadn't been earned yet. Everyone in the chain made more money. Everyone except the buyer, who was now paying more than the original price and didn't always realize it. General Motors moved faster than almost anyone. They set up a finance company specifically designed to lend money to car buyers. Ford refused. Henry Ford believed strongly that people should save and pay in full. He thought buying on credit was morally wrong and financially reckless. He held that position firmly. and he lost an enormous amount of market share because of it. The lesson the rest of the industry took was clear. If you allow people to pay later, they buy more. If you require them to save first, they buy less. From that point on, saving first would be reframed as the old way. Paying later would be rebranded as progress. By the 1950s, the installment plan had grown into something far more powerful. In 1950, a businessman named Frank McNamara left his wallet at home during a restaurant dinner in New York. That single embarrassing moment led him to create the Diners Club card, the first charge card of its kind. Within a few years, major banks were building their own versions. By 1959, American Express had launched its card to the public. By the mid-1960s, Bank AmeriCard, which would eventually become Visa, was being mailed directly and without request to millions of American households. People were receiving credit before they had ever asked for it. The system wasn't waiting for demand, it was creating demand. Advertising shifted at exactly the same time. The message changed completely. It stopped being about the product and started being about the feeling. You deserve this now. Your family deserves better. Don't wait for someday. Someday is today. These weren't accidental phrases. They were written by people who understood psychology and were paid very well to move ordinary people away from one belief and toward another. Away from save first, buy second. Toward buy now, pay later. And it worked. Within a single generation, the meaning of debt changed entirely. It stopped being a source of shame. It became normal, then expected, then smart. People who used credit were seen as modern and sophisticated. People who only spent what they already had were seen as old-fashioned, cautious, behind the times. The culture had flipped completely, and most people didn't notice it happening. What changed inside people's minds during all of this was not a small thing. It wasn't just that people started spending more. The way they thought about ownership, money, and identity shifted in three very specific ways. And those shifts are still running inside most people's heads right now. The first is what researchers call the ownership illusion. When you take something home before you have finished paying for it, your brain treats it as fully yours. Completely. The debt attached to it doesn't feel real in the same way the object does. The car sits in your driveway. You can touch it, drive it, show it to people. The loan exists only on paper, in a file somewhere. So your mind treats the car as real and the debt as abstract. This is why people repaint and renovate homes they can barely afford the mortgage on. The home feels like theirs. The debt feels like a technicality. The brain doesn't weigh them equally. It never has. The second shift is payment framing. Large numbers frighten people. Small numbers do not. $45,000 for a car sounds enormous, but $389 a month sounds manageable, almost reasonable. The total cost hasn't changed. Only the way it has been shown to you has changed. Lenders understood this early. So did advertisers. They stopped showing prices. They started showing payments. And once that happened, people stopped asking how much something cost in total. They started asking how much it cost per month. That is a completely different question, and it leads to completely different decisions. The third shift is the deepest one, and the most difficult to escape. Lifestyle debt becomes identity. Once you have the big house, the new car, the annual holiday abroad, the private school fees, those things stop feeling like possessions. They become who you are. They become the version of yourself you show the world, the version your children grow up inside, the version your colleagues and neighbors see. And pulling back, selling the car, moving to a smaller home, cutting the holiday, doesn't feel like a financial decision anymore. It feels like a loss of self, like shrinking, like admitting failure. This emotional weight is exactly why people in serious financial trouble will often keep paying for the visible, expensive parts of their life long after the numbers have stopped making any sense at all. The machine built in the 1920s and refined through the following decades didn't stop. It didn't slow down. It learned new shapes and found new entry points. Subscriptions are the installment plan rebuilt for a digital age. Every month, small amounts leave your account automatically. For music, for television, for storage, for software, for apps you open twice. The individual amounts feel trivial. Together, they are not. And because canceling each one requires a separate decision, a separate login, a separate moment of friction, most people simply don't. The payments continue. The product is never fully owned. The moment you stop paying, everything disappears. Buy now, pay later services are the installment plan with every moment of hesitation removed. No application, no banker, no conversation. Just a button at checkout, and the item is yours. These services are now built into the checkout page of thousands of retailers. They are designed to catch you at the exact moment you are already emotionally committed to buying something. That timing is not an accident. Lifestyle inflation is the same mechanism without any paperwork at all. Every raise, every promotion, every step forward gets absorbed immediately into a higher level of spending. A better car, a bigger flat, more meals out. The gap between income and expenses stays exactly the same. Sometimes it quietly grows. The feeling of moving forward is genuine. The actual financial progress is not. And then there are employer benefits, health insurance tied to your job, a pension that fully belongs to you only after 5 years, stock options that mature later. These aren't only perks, they are anchors. They make leaving expensive in ways that are hard to calculate, but impossible to ignore. The golden handcuff is a form of debt, just paid in years instead of money. The system sold you a life you hadn't earned yet. And the most powerful part of that sale was convincing you the life was already yours to begin with.